Hello everyone, let's have a brief discussion about bad debts. What are bad debts? Well, no company collects all of the money that it's owed to them. It's incredibly common for everybody that for one reason or another, debts don't end up getting paid. So companies, when they have a receivable on their books that they know they're not going to collect, they can't continue to have it on their books as an asset, because an asset is something that's supposed to help the company generate revenue in the future. And they know that they're not ever going to have that receivable turn into cash, which they can use to further their business. So reporting your receivables in full, even though you're not going to collect a portion of them, is disingenuous to the users of your financial information. Every company has issues collecting. The average American company never collects 1.5% of its receivables. Still pretty low number, but for some industries it tends to go even higher. There's a thing called bad debt to sales ratio. So it's the portion of your net credit sales that you don't end up collecting in the long run. And this number can get incredibly high, varying from industry to industry. It's really high for, say, student loans and credit cards, but a couple other industries, for construction, it is 3.4 to 6.2%, depending on the area that the construction is incurring in. Or if you work in the media, so you run a website, you do advertising, etc., their bad debt to sales ratio is typically 3.5 to 5%. So 1.5 is the average, but it can tend to be much higher depending on where your business is and what industry you are a part of. How long before you consider something to be bad? How long before you can say, okay, we're never going to collect this? Well, there's not a set rule. But the most common number that I see is 180 days. On the smaller scale, I think like 120 is probably the minimum you can get away with before you write up something as bad debt. If you try claiming bad debt after it's been on your books for like 30 days, most people aren't going to allow it. So 180 is the most common. The 120 to 180 range is where most companies tend to lie before they actually determine something to be a bad debt. How do you take bad debt off your books? Well, there's two different ways you can do this. The first is the direct write-off method, where in this method, as soon as you know something's going to be uncollectible, you just write it off on an account by account basis. So if you've had a receivable on your books for, say, 180 days and you're like, okay, we're not going to collect this, let's write it off, you do it right then and there. The other option is to use what they call an allowance method, and that is where companies estimate the portion of their receivables that will not be collected, and they create another account called allowance for bad debt, which is tied to your receivables. You do this in the same period that those receivables go on your books or the sales happen, etc. So who uses what? Who uses the direct write-off method and who uses the allowance method? Well, the direct write-off method has a problem, and that is due to this thing, the gap matching principle. Same thing we talked about during adjustments, that expenses must be recognized in the period that they're going to help your company generate revenue. Well, let's look at this example and say that on June 1st, ABC Company sold $10,000 worth of merchandise on account to XYZ Company. They would have recorded those revenues during June. If they sat around until December 1st and XYZ had still not paid ABC Company, and they decided that this is going to be a bad debt, we're going to expense this bad debt right now, they'd be recording that expense in December. And since they're recording the revenues in June, but the expense for bad debt in December, they're not recording them in the same period. They're not recording this expense in the period that it helped them generate revenue. And this violates the gap matching principle. Which means if you are a company that has to abide by GAAP because you're subject to SEC oversight, you can't use the direct write-off method. Who can use the direct write-off method, however, is small businesses, and most small businesses tend to do so. Again, they're not publicly traded. They don't have to report their financials and have those financials fall under SEC oversight. They can use whatever method they want to come up with their financials as long as an auditor signs off on it. And small businesses will tend to use the direct write-off method for two reasons. First, it's just easier. You don't have to mess around establishing allowances, all of that stuff. You just wait until a debt has been on your books for a certain amount of days. Your computer system tells you it's been outstanding for that long, and you write it off once it hits whatever your point is, 120 days, 180 days, etc. Also, the IRS requires small businesses to use the direct write-off method for tax purposes, which means it's easier for companies to just use this method because it's the same method they're going to have to use when they file their taxes. So they'll already have that number instead of having to go through and calculate bad debt in a different way. Two separate sets of numbers. They just have the method they're using on their books be the same method they're going to use for tax purposes. So most small businesses will use the direct write-off method. If you ever bookkeep for a small business, I advise you to use the direct write-off method. But small businesses don't have to use it. They can still elect to use this allowance method instead. So the allowance method, how does this work? Well, we still know that expenses must be recognized in the period that they help generate revenues. So let's say that Alpha Corporation sells $1 million worth of inventory on account during the month of June. They would have recorded all of that sales revenue during the month of June. They're going to use the allowance method, which means they're going to make an estimate of what portion of those sales they don't think they're going to be able to collect in the long run. And they estimate that 2% of credit sales is about what they typically don't collect. So at the same time that they record these sales, they're going to record their expected future bad debt expense. 2% of that $1 million is $20,000. So they're going to assume that they have $20,000 in bad debt from those sales that they had during June, and they're going to put that bad debt expense on the books in the same period that they recorded the revenues. So the expenses and the revenues for these sales are both on the books in the month of June, and we adhere to this gap matching principle. When you report your receivables, when you're using an allowance method, how do you do so? You do it in the same way that you would have for any asset that has a contra account tied to it, namely like your equipment or your furniture or your building. What you do is you report the asset at its gross value, and then you subtract out the balance of your contra account. So in this case, Alpha Corporation had $1 million in gross receivables. That's the amount that, in total that they have outstanding on their books, but they don't think they can collect $20,000 of it, so they subtract out the balance of their allowance for bad debt, $20,000, to get $980,000. So they're basically telling users of their financial information, yes, we have $1 million in receivables on our books, but we think we're only going to reasonably convert $980,000 of that $1 million of receivables into cash in the long run. And that number that they report on the side is referred to in the business world as a company's net receivables.